Now friends, let us start with the discussion with respect to this particular question, and let me tell you, this is a beautiful question, and you'll have to pay maximum attention on this particular front. And even having completed this particular question, you got to revise this particular question very precisely. This question is worth 10 marks. I repeat, 10 marks. Come on, let me read the question. Z, an individual resident in India, gives the following information pertaining to the income earned in India as well as earned in country X and country Y for the previous year. India has not entered into double taxation avoidance agreement with these two countries. Income from profession carried on in India, 7,50,000. Agricultural income in country X, gross 50,000. Dividend received from company incorporated in country Y, 1,50,000. Royalty received from literary book from country X, gross 6 lakhs. Expense incurred for earning the royalty, 50,000. Business loss in country Y, proprietary business, that is 65,000. And rent from a house situated in country Y, 2,40,000 gross figure. And municipal tax in respect of the above house not allowed as a deduction in country Y, 10,000. Business loss in country Y is not eligible for set off against the other incomes as per the law of that country. Tax rates in country X and Y are 10% and 25% respectively. Compute the total income and the tax payable by Z in India. Now friends, as I already told you that this is a beautiful question and you will need to pay maximum attention. Let us make the basic notes very properly. Z, resident individual, okay, and he has got a foreign source income from two countries. So here you will have to do adjustment with respect to two countries, friends. So you got to be very careful. And India has not entered an agreement. India has not entered into an agreement with that particular foreign country. India has not entered double taxation agreement. And this is a clear situation, section 91. And section 91 will directly, friends, come into picture with this particular situation. So it's a resident person having a foreign source income and relief, rebate, deduction, whatever you want to say, from the tax liability will be available as per section 91. Okay, so let's start with the computation. So all basic condition is already through. Okay, so income, business income, profession in India. So this will be of course taxable in India. Agriculture in country X will be taxable in India. Different will also be taxable in India. Now, two things let me tell you very precisely. That agricultural income from one country is taxable in India. See, Indian agricultural income is exempt in India. However, the agricultural income from the foreign country is not exempt in India. That means it will be taxable in India. Secondly, dividend received from foreign company is also taxable in India. Logic is very simple, that foreign companies do not pay, I repeat, the foreign companies do not pay the dividend tax in India, and therefore the dividend from foreign company is taxable in India. Mamma mia. And pay maximum attention, as I already told you, darling. Don't miss out on this particular question, friends. Okay, question ID number 16. Mr. Z, resident in India. Okay, India and that country do not have any DAA. Thus, section 91 is applicable. Okay, computation of income. Indian income 7,50,000. Country X. Actually, friends, this particular computation we should always do it headwise. But whenever there is a DTAA question, we actually do it country wise for better understanding, and hardly matters in this particular situation. But if you ask me, sir, exactly what you should do, so exactly you should do computation headwise only. Okay, so country X, from country X I've got agricultural income which will be taxable in India. Okay, country Y. I got a dividend from foreign company. Basically, I will just write dividend. That is 1,50,000. Now, the X next for earning that particular round. The points will be considered and taxable. Basically, net income will become taxable in India, and for this for that is 80 and under that you will get a special deduction of 3 lakh rupees. However, friends, this particular question is not a question in relation to chapter 6a. So what we can do is we can just write one note, assume that all the conditions as required under section 80 QQB is 3 lakh rupees and you are eligible for the purpose of deduction. Okay. So this one small little note that you should add it up by yourself. So this is from country X, royalty 6 lakhs, expense for royalty 30,000. Okay, I'll leave some space and thereafter I will get GTI from that deduction 80 QQB 3 lakhs, and I will get a total income. Okay. This is one extra adjustment I've done. Come on. Now, business loss in country business 65,000. Indian government, Indian law, we have that carry forward set of intrahead, interhead, and all this kind of adjustments that we already have it. Now, basically, it is a business loss from the foreign source. So, anyway, the set off is permissible because had it been income, income would have been taxable. Had it been a loss, loss will be eligible for the purpose of set off. So, in India, you will get this particular set off. However, in the country Y, it is already given to us in the question that it is not eligible for this particular loss as per the law of that country. However, in India, so you are going to get it, no? So right now, what we are doing is an Indian computation. So in the Indian computation, we will give. However, it is not allowed as a set off of that country and all that. That we will do, but at the time when we are doing that foreign rate calculation and all that kind of things. Okay. So from the country Y, we have a business loss now. Doing that particular set off. Okay. The next thing that we have is rent from a house situated in country Y. So this is a house property income. This is basically property in foreign country. So in India, of course, this particular money will become taxable. There is no doubt about it that. And municipal taxes as per that country in that country, but in India, so it will be allowed as a deduction. So basically, what we have to do is that whatever is your house property computation in India, so we will have to do it as per the Indian law only. So in India, we will consider 40,000, consider this municipal tax plus house property income. We also have standard deduction of 30% in India. That also we will give. Why not? However, the law of that country is not going to give. That will come in your foreign rate calculation. Okay. So in India, I'll have to consider 12,000 minus 10,000 and 30% standard deduction of house property. Okay. So house property income 2,40,000, municipal tax 10,000, balance 30% standard deduction. Okay, and net figure 1,61,000 rupees. Okay, just keep on checking the calculation. Okay, so that's all about all the adjustments. So you can just take the total in the outside column. Country X is 6 lakhs net figure, and country Y is 2,46,000. Outside column, gross total income is 15,96,000 and the total income will be 12,96,000 rupees. Okay. Now, tax liability calculation. all basic calculation, basic exemption, slab 1. Now these so many times I've already showed you all the tax liability calculations, so you can start multiplying by yourself quickly. 87A rebate on merit, surcharge and cess. Okay, you will get a total tax liability. You can say tax liability. Okay, from the tax liability you will get a rebate, or you can say deduction, relief, whatever, under section 91 with respect to country X. Indian average rate, foreign average rate, whichever is less or whichever is lower in terms of rate, multiply with doubly taxed income and get the amount of the rebate. Similar rebate you will get it again with respect to that country Y. So rebate under section 91, country Y, and same style, Indian average, foreign average. Okay, whichever is less or whichever is lower, these will be all percentages. Doubly taxed income, when you will multiply with this, you will get the rebate. You will get two rebates basically with respect to both the countries. Then your net tax liability, you will get it. Okay, this is the structure of your answer, entire answer that is already developed in terms of tax liability calculation. Okay, now the real action of this particular question starts, and you guys of course will have to pay maximum attention, baby. Hakuna Matata means no worries. Now pay maximum attention. See, you want the foreign average rate, okay, and you want doubly taxed income in respect to both the countries. First I will start with country X, and on a similar basis thereafter I will do it for country Y also. Okay, now before I go ahead with this particular discussion only, let me tell you that ICAI, our Institute for Answer Solving, follows a particular opinion. However, there also exists an alternate opinion on the subject matter. So first of all, you will solve it absolutely as per the ICAI only, and thereafter what is the alternate view, that also I will tell you in terms of discussion. Okay, so you want foreign average rate and you want doubly taxed income. These two things you always require for the purpose of claiming any benefit under section 91. Now see, first of all, this is for country X, and similar basis we will do it even for country Y. Okay, now in relation to country X, we had agricultural income, 50,000, royalty income 6 lakhs, expense to earn the royalty was 50,000. Okay, now there was 80 QQB, one of the only thing, I'm just gathering the data first of all, which Indian law in relation to this country had done it. Okay, 80 QQB was a deduction of 3 lakhs of rupees. Okay, now foreign rate of tax, which is already printed in the question, is 10%. See this, the tax rate of X and 10% and 25% respectively. So it is 10%. Okay, now just imagine, if the foreign government is going to tax you at a particular percentage, it will tax you as per the law of that country. 80 QQB is a deduction which the Indian law is giving you. The foreign law is not going to give you. Foreign law is not going to give you. The working that we are doing here, listen very carefully, is a foreign average rate. The calculation which we are doing here is calculation of the foreign average rate. So what you want is, for average rate calculation, you want two things very precisely. You want income, and second thing you want is how much is the tax that you are paying in that country. So just like our Indian average rate comes based on total income and tax liability. Similar basis we want it even for the foreign income. We want total income, but we want foreign income basically here, and we want the foreign taxes. These two things, once you get it, then only you can get a foreign average rate of tax. Okay, so these two things that you already require. Okay, so first of all, you want foreign total income. So okay, so this is what you can call it as a foreign total income, or you can say foreign income. You can say this is your foreign income. 3 lakh rupees foreign law is not going to give you deduction. That's the reason I have written it, and thereafter I have cut it. Now, so foreign income is now it is coming to how much? Total 6 lakhs. Okay, this total is 6 lakhs. Of that, 10% is the foreign rate of tax. So foreign tax is going to be 60,000. Okay, foreign rate is going to be 10%, which is already printed in the question. On that, you are going to pay a tax in foreign country, which is 10%. So you are going to pay 60,000 rupees as a tax in that particular country. Okay. What is a doubly taxed income? Okay. Doubly taxed income is basically an income which is taxed in both the countries. So now doubly taxed income, you can imagine like this. This is a small little working note if you want. It is a working note. Okay. See, India, sorry, I will say foreign country first, and thereafter I will say India. Okay. In the foreign country, you had 50,000 income, 6 lakhs income, and 50,000 the expenses. This was your foreign country. India also, you are taxing foreign agricultural income is taxable in India. 6 lakh rupees, which is your royalty income, is again taxable in India. Whatever is the 50,000 expense to earn the royalty income is also considered for the purpose of taxation in India. However, in India, you are also getting 3 lakhs rupees extra deduction on account of 80 QQB. Okay. Now, friends, one of the point here is that the doubly taxed income means the income should have been taxed in both the countries. If any one country, I repeat, Mama me, I repeat that if any one country, I repeat that if any one country is not taxing an income, it is not a doubly taxed income. Mama mia. For a doubly taxed income, it has to be taxed in both the countries. Okay, so if one country has given you some relaxation, to that extent, it is not a doubly taxed income. So the income of that country is 6 lakhs, but out of 6 lakhs, what is taxed in India is only 3 lakhs. Okay, so you can say like that, but don't write these words in the exam. These or these, whichever is less. Whichever is less. These or these, whichever is less. But don't write these things in the examination condition. In exam, what you have to write is, to the extent of 3 lakh rupees, it's an income which is reduced in India because of the deduction, and therefore to that extent, it is not a doubly taxed income. So, the doubly taxed income in the circumstances is a 3 lakh of rupees. Okay, so what you can do is, because this was working for country X, we are doing no, so you can update this. See, foreign rate is 10% and doubly taxed income is 3 lakhs of rupees. This is how you can keep on updating that particular table. Okay, now let's do it for country Y. Exactly similar situation. Let us do it for country Y. So country X we have understood, and that alternative view also I will tell you, don't worry. Okay, so country Y, same format we will follow. Okay, ICAI follows a particular method, and there is alternate situation also. Okay, now in relation to country Y, you had a house property income which was 2,50,000. Municipal taxes was not allowed as a deduction in that country, and standard deduction which normally Indian law gives, that law is not giving you. Had it been they giving you, then they had to print it in the question. Okay. Then there was a dividend income, 1,50,000. There was a business loss, 65,000 loss, but that country law is not giving you the set off. That's the reason I'm cutting it. Okay. Now with this, you will require foreign income, foreign rate, and foreign tax. Okay. So see, foreign income, foreign rate, and whatever is the foreign tax that you are going to pay in that particular country. So if somebody asks you that how much tax have you paid in that particular country, okay, so foreign income as per the law of the foreign country is 3,90,000. So supposing if you were to compute the same total income as per the law of that country, but as per our logic and as per the question data, whatever is printed in the question, your foreign income as per the foreign country law is going to be 3,90,000. The rate of tax is printed is 25%. That is already given it to you in the question here. So supposing if you have to ascertain that how much tax, actual rupees amount equivalent tax which is paid in that country, if you have to ascertain that, so you have to multiply 25% to 3,90,000 and get the amount that is 97,500 is the amount of tax paid in that particular country. But what will be the doubly taxed income? So doubly taxed income is a different analysis altogether. Okay, and the doubly taxed income, you imagine the situation foreign country and India. House property income was 40,000, dividend was 1,50,000, and there was a loss of 65,000, but that is not allowed in that country. Okay, now in India, 2,40,000 was the house property income, but Indian computation of the house property became 1,61,000 because of that 10,000 municipal tax and 30% standard deduction of the house property chapter. 1,50,000 dividend is as it is, and this 65,000 Indian law is going to give you the set off which the foreign country is not giving you. So the income as per the foreign country was 3,90,000, but on a similar basis as per Indian law, it is becoming 2,46,000 rupees. Okay, just keep on checking the calculation. Okay, now logically you can say whichever is less, but don't write these things in the examination condition. I'm warning you, baby. I'm warning you that don't write this word less in the examination condition. Don't write it. No law says that these or these whichever is less. No, law doesn't say that. Keep that in mind. Law doesn't say that. Okay, but our understanding inside our back memory, you can say these or these whichever is less. So that is your doubly taxed income. Okay, so doubly taxed income is 2,46,000 rupees. Okay, so once you have got this doubly taxed income and the foreign rate, you can update in your main answer. You can update it in your main answer that the foreign average rate is 25% of country Y and the doubly taxed income is 2,46,000 rupees. And then you can start doing the multiplication and arrive at the rebate under section 91. Okay, now friends, let me tell you the alternate view, what the alternate opinion which prevails on this particular front. Okay, now alternate opinion says that, listen very carefully, the different school of thought in this particular situation says that the foreign tax which is paid in the foreign country, it is same to same. See, this figure cannot change. The tax which you have paid in the foreign country is a fact. See, like for example, if somebody asks you how much tax you have paid, so you will say that this much I paid by TDS, this much I paid by advance tax. So all this proof of payment of tax you will have, no. See, every country will have the law. So for example, if you are saying that you have paid 60,000 rupees tax in that country, the documentary proof of the payment of tax will of course be there. Okay, so this is a number which is not going to change. This is a number which is not going to change in any situation. Okay, second thing, that what is a doubly taxed income? For these also there is no controversy. Doubly taxed income is that income which should have been taxed in both the countries. If any one country is not taxing it, then it is not a doubly taxed income. There is no controversy for that. This is constant. Okay. But now the main point here is calculation of this particular percentage. Okay. See how this percentage actually gets calculated. It is tax liability and total income. Normally, as per our Indian average rate, what we want is a tax liability total income. These two figures you want. Okay. So similarly, you want for the foreign country, you want tax payment figure and you want the total income of that country. That means you want basically taxable income of that country, on which how much tax you have paid. These two numbers you want. So this 60,000 is not going to change, but this figure, that what is the income of that particular country, there the different school of thought exists. So different school of thought says that, okay, we want the foreign income only. So we want the same figure of foreign income only. Okay, but we want, the different school of thought says that we want foreign income as per the Indian law. I repeat, we want the foreign income as per the Indian law. So Indian law has already given you a deduction of 3 lakhs. So your foreign income as per the Indian law is 3 lakhs of rupees. Your foreign income as per the Indian law is 3 lakhs of rupees, for which you are paying 60,000 of tax. So now when I take out a percentage out of this, I get 20%. I get it as 20%. And this will create a little bit of an alternative view and a little bit of a controversial issue in this subject matter. Mamma mia. Hakuna Matata means no worries. Friends, you got to pay maximum attention on this particular front, and moment your foreign average rate will change, moment it will change, your whole answer will change. But institute does not follow this particular interpretation. Okay, so behind this particular interpretation, see what is the main thing. I'm just telling you the main thing. It is tax paid over total income, but foreign total income, as per the Indian law. And alternative view will be foreign total income as per the foreign law, based on the question data. So whatever question data is given, accordingly we have to get that particular breakup. Now for a moment, friends, I will take you to this particular barrack provision for the purpose of analysis, and just come to this particular page and thereafter, in fact, it is not a big kind of interpretation, but I will of course show to you where that different school of thought comes into picture. Now, basic things first. That's success your option. Okay. Here is what Indian income, foreign income area. This is section 91. Okay. Indian country does not have any agreement. Only then this section 91 will come into picture. Okay. Then should be tax in particular country, for which you want some deduction, rebate, etc. Okay. Deduction from the Indian tax payable. So this is basically your tax rebate, you can say, or you can say tax deduction. Basically, it is adjustment from the tax liability calculations. Okay. This deduction, the tax income, I already explained that to you. It is income tax in both the countries. Okay. Now the incomes. Now you get a rebate based on doubly taxed income. At Indian rate of tax is the problem. The reason being that we know total income, we know tax liabilities, rate of tax on actuals we can always calculate. Or the rate of tax of the secondary which is lower. This rate or this rate, whichever is lower. Now this rate of tax of the said country. Okay. So here that school of thought comes into picture. Okay. So it is foreign income as the foreign law. This is one school of thought, and second school of thought is foreign income and as per the Indian law. Okay, this is your income figure and tax paid in foreign country. You have to average it out. See, this is tax paid in the foreign country. You have to average it out. Okay, tax paid of a country is not going to change, but it is a fact that cannot change in any situation. Okay, and so your income computation method of this is basically foreign income computation method, little bit varies as a different alternate opinion, so you get a different rate of tax. And moment you get this different rate of tax, that means different percentage you get, mamma mia, your whole answer is going to change. Is that absolutely clear? Now, on a similar basis, friends, let's do it for country Y also. Okay. Now see, for country Y, our house property income computed in India was, after that municipal tax and 30% standard deduction, was 1,61,000. Dividend figure is as it is. The Indian law is giving you a particular set off. Okay. Now tax figure is anyway going to remain constant. That is not going to change. Okay. So this figure is going to be 2,46,000. And now this percentage is going to change because this particular figure of 2,46,000 has changed. So this percentage is going to undergo a change. So for the percentage, friends, you need a tax payment of foreign country and you want income of, because tax and total income, that only gives you the average rate of tax. And here you get a percentage. I'm getting 39.63 percentage. And moment this percentage change, baby, your whole answer is going to change. I'm telling you, baby, your whole answer is going to change. Okay. And so this is how your percentage changes. However, your doubly taxed income, there is no change because concept of doubly taxed income is constant. So that is not going to change. Is that absolutely clear? And accordingly, you have to update your answer. Okay. So now you update your answer. However, this alternate view, as I already told you, the institute does not follow that in the examination condition. Come on, baby. Now go ahead and update your answer. Mamma mia. Hakuna Matata means no worries. It's a problem free. Now, friends, from this particular question, first of all, make a note that, see here, no, like this kind of table, friends, I have given you everywhere in almost each and every chapter. And these are basically the list of important question types. So don't miss out on this particular front. Reason why I'm telling you that once you will do this, no, the major concept of each and every chapter will get clear. So here I've already said, see, this is the chapter ID number, this is the question number, and some synopsis and its status, very important or important. Like this I've already given almost to you in each and every chapter. So you better go through it very precisely. Okay. Now, friends, these are some of the homework questions on DTAA. So this you can do it by yourself. It has also got some of the good points, friends. But now everywhere this majority of the tax liability calculations, standard type calculations. So I'm not spending more time on this particular chapter because otherwise it will amount to spending undue time on a favor of a particular chapter. Now, friends, in these homework questions, just come to one question which I want to discuss. Actually, I don't want to solve that, but it is a good concept and something different and which I want to bring to your notice. Okay. Come to this particular question, friends. Question ID number is 109. Okay. Now, friends, let me read this particular question. I will just explain this particular question and working of this particular question. You can see it in my homework material, friends. So working wise, it is not a great job, but concept wise, it is a good thing. That's the reason I'm just discussing this particular question for a short while. Okay. So the concept I want to clarify. Otherwise, working, you can do it by yourself. Okay. Why a non-resident Indian and aged 47 years has derived the following incomes during the year? Income from deposits in India, 8,25,000. Share of profits from the firm Messrs YZ. Messrs YZ is registered in country X, having control and management partly from India. Firm Messrs YZ is having a global operations and 2/3 of its income is sourced from country X. Mr. Y has paid tax in country X, rupees 2 lakhs, in respect of his share of profits, as much as it relates to country X. India has no double taxation avoidance agreement with country X. Compute the income and the tax payable. Now friends, this particular question has got a unique feature of section 91. Okay. Now remember one thing, that up to now all the questions that we have solved was all basically based on section 91, and under 91 friends there is a general provision called 91.1, and this is the most popular and a very famous section, and it takes care of almost all general category of transactions. Okay. However friends, under section 91 there is also subclause 2 and also subclause 3. Okay. The operation wise, I mean calculation wise, it is the same only. So calculation wise it is no different. However, subclause 2 is a specific situation and subclause 3 is a specific situation of giving a rebate or a deduction which is similar to section 91 only. So working wise it is no different, but it is a specific situation. Okay. And this particular question friends, it is 91 subclause 3, where assessee is a non-resident. I repeat, this particular question is based on a specific situation where the assessee is a non-resident and it has got some transaction with a country with which India and that country does not have any agreement, and this gentleman has got the share of profits from a partnership firm, Messrs. YZ. And this is one of the very unique feature, that is 91.3. Concept wise it is same only. I mean it is no different concept, like there is a doubly taxed income, but doubly taxed income, taxed in that country, taxed in India also, you have paid tax in one of the countries. So that basic concept is the same. Working wise also it is the same, like average rate of tax, Indian average rate, foreign average rate, whichever is less. Working wise it is no different, but situation is different. Up to now friends, whatever that we studied under 91.1, that was basically for resident assessee. Okay, 91.2 is also one of the specified situation, but that is also for the resident assessee. But 91.3 is one of the special situation of non-resident assessee. Okay, so first of all friends, I want you guys to come to that particular section. As I already told you that working wise it is the same only, so you will not face a great problem once you have the solution with you. But see, I'll just go to that particular section first of all, 91.3. Okay, and that particular clause I want to basically wanted to discuss with you. That's the only reason I picked up this particular homework question. See, 91.1. Okay, 91.1 you see, where person who is a resident in India, and almost every question what we have solved is based on 91.1. Okay, so same concept is there of section 91.2 you see. 91.2 is also duplicate only of 91.1, but only it relates to a specific income type. Okay, so here also assessee is resident, and the income now it's a specific income. Okay, under 91.2, application wise it is the same only. So income which accrue or arise to him in Pakistan. So Pakistan is naturally outside India, no? See, under subclause 1 it was any income which was outside India, but now here it is a specific income which is in Pakistan. Okay, and income which accrues in Pakistan and all other things is almost practically the same, which is in nature of some agricultural income. Okay, so same type, same application friends, but it is it may be called as Pakistan agricultural income. So if there is any resident in India who is having this Pakistan agricultural income, then application working wise it is the same. So foreign rate, Indian rate, whichever is less, that way it is the same. Okay, so there is no problem here. Okay, now see 91.3. Now 91.3, I want you all guys to pay a little bit of extra attention and understand the situation, because here the assessee is a non-resident. Okay, so now this is a unique relief. Remember this very carefully, that this is a unique relief under section 91 with respect to non-residents. Okay, and what kind of situation is this? So it's like any and every transaction of non-resident will not have a relief of section 91. This is a specific situation, a specific type income of non-resident which will be eligible for the purpose of rebate under section 91. It's a specific situation only. Okay, so non-resident, and you have share in the income of a registered firm, assessed as a resident in India. So situation is like that. You are a non-resident. Okay. You have share of income from a registered firm which is assessed as resident in India. So basically a resident firm. Okay. And such share, so whatever the share that you have already got it, includes income accruing or arising outside India. Okay. So see, it's a non-resident assessee. The firm is resident in India and you have income outside India. So non-resident having outside India income, but in form of share from a firm which is resident in India. So basically the situation is like that. I'm a non-resident and I'm having some share of profits from a firm which is resident in India. Okay, and that share includes some of the foreign incomes. Okay, so non-resident for foreign income is not taxable in India. No. See, and logic is this way: a non-resident and the foreign income, okay, is normally not taxable in India. Okay, and because it is not taxable in India, and if it was taxed in India, you are going to get double taxation avoidance relief. So you are going to get a relief because something which was not taxable in India have brought to tax. Why? Because the firm was resident in India. Okay, so that is the clear situation in this particular section. Okay, so but this is only for respect to the share of profits. Okay, and the share should include income accruing arising outside India. Okay, and there is no agreement because balance part of the law of section 91 is the same. Whatever was section 90 subclause 1 condition, this also will be the same. India and that country does not have any agreement. Okay, and you have already paid the income tax on this particular kind of income which is so included. Okay, in respect of income which is so included, okay, then he will be entitled to a deduction, that means a double taxation relief from the Indian income tax payable. So from Indian income, the basic operation is the same. Okay, some calculated on a doubly taxed income. Okay, so just imagine that non-resident, okay, and having outside India income is normally not taxable in India, but it was included for the purpose of computation, and therefore this particular relief of double taxation is made available to the assessee. But don't forget that this outside India income which I am referring is only one type of income, and that type is a share of profits from the partnership firm. Okay, so any and every income will not be covered under this particular category of double taxation deduction. Okay, so deduction you will get Indian income tax payable, some calculated on such doubly taxed or Indian rate of tax, okay, whichever is lower, and if both the rates are equal, then it will be the Indian rate. Okay, so entire operation wise it is the same, calculation wise also it is the same. Okay, now once you know this particular provision, then you can come to this particular question directly. And see, the question has created the same situation of section 91(3). Okay. See, assessee is a non-resident. Listen very carefully. Assessee is a non-resident. Okay. Now, there is a share of profits from a firm which is YZ. YZ is registered in country X, but control and management is partly from India. Since control and management is partly from India, this firm is going to become resident in India. This is one very, very important thing. Because the control and management is partly from India, this partnership firm is going to become resident in India. Okay, and that's the reason it will be squarely covered by section 91 subclause 3. Okay, now the share of profit which is there, okay, it is given to us in the question that this partnership firm has a global operation. 2/3 of the income is from country X. That means 10 lakh rupees is outside India. Okay, and the 5 lakh rupees is inside India. So this non-resident will include the entire 15 lakhs for the purpose of calculation, but the 10 lakhs is outside India. So these 10 lakhs is something like double taxed income. Okay, because non-resident and outside India share. I mean, of course, the share of profits, but as much as it relates to outside India. Okay, so that is normally not taxable in India, but it is included for the purpose of this particular calculation, and therefore it will be eligible for the purpose of a rebate of section 91. So doubly taxed income will be 10 lakhs, and on that you have paid 2 lakh rupees of tax as much as it relates to country X income. So doubly taxed income will be 10 lakhs. And because you will need the foreign average rate, no, so tax paid will be 2 lakhs, okay, as much as it relates to the country X income. That means on this 10 lakhs you have paid 2 lakh rupees tax in that country, okay, so that you have to prove it. So your average rate of tax of foreign country is going to be 20%, okay, and then you have to include everything, okay, and you have to get Indian rate. So Indian rate is a normal Indian tax liability calculation, and you will get Indian rate, you get a foreign rate, and then whichever is less, doubly taxed income is 10 lakh of rupees, okay, and that will be the amount of rebate under section 91(3). So that way it is a homework question. So that detailed working of tax liability and all that, you can see it in that particular answer in my homework sheet. Answers I've always given it to you, so you can see it in that particular sheet. Okay, now friends, together with this, one very good confusion which will be arising in the minds of the student. Now that way the answer is over, but understand one very, very important concept of taxation of partnership firms. Okay, the share of profits which is normally available to a partner, listen very carefully, is exempt under section 10(2)(a) of the Income Tax Act. Is exempt under section 10(2)(a) of the Income Tax Act. Now, the first confusion which will come to the minds of any Tom, Dick and Harry, Mamma mia, I am telling you, this confusion should come. In fact, if this confusion is not there, no, then it means that you haven't studied the taxation of firm also properly. Okay, now remember this very carefully. The share of profits is normally exempt under section 10(2)(a). If it is exempt under section 10(2)(a), then why am I including this 15 lakhs for the purpose of calculation? Okay, the share of profits is normally exempt. So if this 15 lakhs is exempt only, then it is not doubly taxed. But then why am I including this 15 lakhs for the purpose of calculation and doing this section 91 adjustments? Have you understood that? Now this section 10(2)(a, that is a small little controversy also, and there is a small little extra point also which I want to bring to your notice. Okay, now section 10(2)(a, if you will actually go through it, it says that where there is any partner of a partnership firm which is separately assessed as such, so basically you can say share from a firm which is assessed as such. Okay, so this is mentioned which is assessed as such. So if a firm is assessed as such and a partner is getting a share from this partnership firm, it is exempt. But what do you mean by assessed as such? Assessed as such is further referred to under section 184, and which to an extent I have explained to you also in my chapter of partnership firm. And this particular section 184 basically says that, okay, that it has to be evidenced by a instrument in writing. So basically, partnership firm should have a partnership deed. Okay. However, registration is not a condition. So section 184 does not say that it has to be a registered partnership firm, but it says that it has to be evidenced by an instrument in writing. That means it has to be a partnership deed. So interpretation here is that this partnership deed should be an Indian partnership deed. However, law does not say that. And this is a small area of debate, that it should be a Indian partnership deed. So basically it should be a partnership firm of Indian partnership instrument, whatever is the Indian partnership law, the firm which is governed by that particular Indian partnership law, that particular firm will be covered by this particular situation. So if you have a share of profits from that partnership firm which is covered by Indian partnership law, because it has to be instrument, the instrument has to be Indian instrument, Indian partnership, only those firms, whatever the share that it gives to the partner, those share in the hands of the partner will become exempt. So basically what we say is the share of profits, listen very carefully. Now, the share of profits of an Indian firm, okay, this will be exempt. But if there is a share of profits, but if it is a foreign firm, it will be taxable. This is one of the important message while interpreting section 10(2)(a). However, this is very debatable. Some people also say that if the firm is paying tax in India, then whatever the share of profits of that particular firm should be exempt in India. That kind of opinion also some people take it. Okay, but this is a very popularly accepted view. The share of profits of Indian firm will be exempt in India because it should be assessed as such in India, and there assessed as such means it has to be evidenced by instrument in writing. That instrument should be Indian instrument because we are talking about Indian law is a interpretation. Okay, now if you will see this particular firm here, listen very carefully. If you will see this particular firm here, this firm is registered in country X. Okay, but control and management is from India, partly from India. So it has become resident. Okay, but it is registered in country X. So this is not governed by Indian partnership law. Not covered by Indian partnership law. Okay, and therefore we will say that whatever this particular share of profits from this particular firm, these 15 lakhs of rupees, is not covered by section 10(2). That means it is not eligible for the purpose of exemption. Is an interpretation. It is a very popular interpretation. However, this is debatable. Okay, now what will be the alternate and the opposite view? Let me tell you. The opposite view will be that, see, because the firm is resident in India, because the firm is resident in India, it will pay full tax in India. So alternate people will say that this is exempt because government has already got taxes, because resident firm is liable for global taxation in India. So whatever the share you have, you give exemption. So this 15 lakhs is exemption. So there is no question of any rebate coming into picture. That will be alternative view. But that view should not be followed for the purpose of examination condition. However, in examination condition, friends, you have to write both the views and very precisely. Okay. So to conclude, this is how you can say 10(2)(a), share of profits from Indian firm, okay, and will be exempt. That's okay. Okay, and share of profits from foreign firm will be taxable. Now, if you want to extend this foreign firm, these foreign firms can be resident or it can also be non-resident depending upon the situation. Okay. So we are not talking about residential status here. So we are not talking about residential status here. We are talking about foreign firms. So the share of profits in the hands of the partner from a foreign firm will be taxable in India. And this view is a very popular view from taxation point of view. Mamma mia.